Hello there. Welcome back to grade 11 business studies. Still working on question papers. So we are going to look at a typical examination question that we have from a past exam paper. So this question is on business ventures, and we are going to start to look at question 2.1. So question 2.1 reads mention three sources of funding, and our question has got three marks. So very important. So basically, it means we have to raise your three points, that is three sources of funding. But we know that sources of finance are very important in the operations of a business, and companies always seek sources of funding to grow their businesses. So we can call them funding, and we can also use the name financing instead of funding, representing the same thing. So this represents an act of contributing resources of finance in the operations of the business. That is funding. So we see that the funding can be short term, can be long term, depending on the funding that you have sourced as a business. So it can be subdivided into short term funding and long term funding. And obviously, it depends on the repayment. That is, the period of repayment determines whether it's short term or long term. So this is what we have. So all the sources of finance, sources of funding that we have, we can just try to see on the list that we have that we have got equity. Equity capital is a source of funding. Equity capital, these are resources that has been introduced by the owners of the business, or own capital, meaning the same thing. This is what we have in the first. And then number two, we have got borrowed capital. This is borrowed capital, or call it debt. And we have got grants from government, debenture. We also have lease or hire purchase, and then we've got an overdraft, trade credit, and then we have got venture capital. So from these sources of finance or sources of funding, you are going to choose three from there. Remember, our question has got three marks, so you can choose any three from the points that we have. Then we go to the next part of the question, and you see that it is outline three steps to follow when drawing up an action plan. And you know that an action plan, maybe we can start by understanding an action plan. An action plan, this is a popular project management technique. So basically, it's a project management technique that lists your action steps, as you know exactly how you are going to accomplish your goals. So it comes as a list of your action steps. So that is an action plan. So this is what we have. So the question is asking us to outline three steps that are involved in an action plan. So if you go to our response section, you'll see that one of the steps is that there should be a summary of vision, mission, goals, and objectives. So this becomes one of them. And then work breakdown structure. There should be a work breakdown structure. Then also an action step chart and timelines indicating targets and deadlines. And lastly, we have got the Gantt chart. So this is what we have in terms of steps that are required. So going back to our question part, we see that now we have question 2.3. We have question read the scenario below and answer the questions that follow. So we're given a scenario there for Camelisa Incorporation. In brackets, we've got KI. And then on the extract section, it reads Camelisa Inc. needs a large amount of capital for expansion of their business. KI decided to convert the current business into another type of business so that they would be able to sell shares to the public on the Johannesburg Stock Exchange. So on the question part 2.3.1, reads identify the form of ownership of Camelisa Incorporation before they were converted to another type of company. And then you have to motivate your answer by quoting from the scenario above. So the first task that we have to identify the form of ownership. So if you go back there, you'd see that Camelisa has got an abbreviation of INC that we have there, and also we see that it is being named a corporation, and we saw that this represents that it is a personal liability company. Why? Because the personal liability company, its name must end with the word incorporation, and also it should have an abbreviation of INC. So you'd see that also one of the characteristics of personal liability company in terms of the title of its name, it is important that it is mentioned. The INC should be mentioned at the end of the name. It should not be at the middle or at the beginning. As we are seeing, the INC is coming at the end. We've got Camelisa and then at the end. So basically, this represents a personal liability company. So if you go to our answer section, you'll see that we have got a personal liability company. And on the motivation, it reads Kamelesa Incorporation. So the INC is there and the corporation is there, which represents that it is a personal liability business. So we try to go back and see in terms of the next question that we have. So on the next question, 2.3.2 reads, name the form of ownership which Kamelesa wants to be converted to. But if you refer back to the question, you see that it want to be, it is the last sentence saying so that they would be able to sell shares to the public on the Johannesburg Stock Exchange. And you know that when it's now selling shares on the Johannesburg Stock Exchange and it's being sold publicly, we know that it becomes a public company. So this is what we have. So this is the hint that we have in terms of identifying which company is being converted to. So if you move on and try to see there on 2.3.2, it's a public company, so it becomes a public company. Why? Because of the element of selling shares publicly and on the Johannesburg Stock Exchange. It represents that that is a public company. Then you go on to the next question. The next question is that differentiate between the forms of ownership identified in question 2.3.1 and 2.3.2. And we know that we have identified here as a limited liability company 2.3.1, 2.3.2 we identified as a public company. So those are the two different forms of ownership that we are going to differentiate. So going back again to our answer section, we'll see that we've got a table that we have whereby we have the column of personal liability company and the column of public company. So we are going to go difference by difference there and try to refer back in terms of the number of marks that are there. Our question has got 8 marks. So basically 4 differences, you are supposed to raise at least 4 differences. So if you come here, the first discrepancy that we have between the two, number one is saying may not offer shares to the general public if it's a personal liability company, but if it's a public company, I trade these shares publicly on the Johannesburg Security Exchange. So this is the first difference. The second difference is that shares are not freely transferable, but if you go to public company, shares are freely transferable. Then third point, a minimum of 1 director. Under personal liability company, then public company, it's minimum of 3 directors. Then we go to again to personal liability company is the next difference that we have. Name must end with INC, like we were trying to illustrate, but for a public company, the name must end with limited, with LTD. Then next is saying annual financial statements need to be audited and published under personal liability company. And then you go to public company, annual financial statement need to be audited and published. So under personal liability company, we are saying annual financial statements need not be, so they are not audited and published. But under public company, they are audited and published. So that becomes a difference. So the next one is saying does not need to publish a prospectus as it cannot trade its shares publicly. So no need to publish its prospectus. But if you go to now to public company, you have to register and publish a prospectus. So they have to publish, and personal liability company does not have to publish to publish. So under public company reads have to register and publish a prospectus with the companies and the intellectual property commission, which is CIPC. And then on the next, which is the last one, the company is not required to raise the minimum subscription. That is the issue. That is issue minimum shares. But if you go under public company, must raise a minimum subscription prior to commencement of the company. So these becomes the last discrepancy that we have, or the last difference that we have according to the comparison that is there between a limited liability company and a public company. So this is what we have. Going back to our question, you see that this is 2.3.3. We go to the next one, which is 2.4, which is saying discuss the reasons why entrepreneurs may need to purchase in existing business. But basically, in existing business, we know that there are advantages that are there because this business has been operating for some time. So there are benefits that this business has been enjoying, that if we purchase it, we are also going to enjoy the same benefits that they were being enjoyed. Remember, there are already existing customers that are there that are loyal to that business that we are still going to retain as we operate as a new as new ownership of that business. So this is what we also. If you go to our answer section now, you'll see that these are the reasons why entrepreneurs may decide to purchase an existing business. So the first one is saying easier to raise finance if the business is a good history. or image. So the good image that has been set by the previous business also is going to be a positive to us as the new owners of that business. So second point is saying immediate cash flow is there already established customers. Yes, the issue of customers there are customers that are always loyal to that business that have been there sometime. So we are going to retain them as we start to operate that business. Then our market research has already been done if there is an established customer base, which is also correct. And the next one is saying distribution, supply links, staff network are already established. So perhaps also an advantage. And then next one is saying a market for business products or services has already been established, which is clear. And then existing employees and managers who have experience, they can share. Then lastly, many business problems have already been solved. So they have already have some action plans that are there in terms of the problems that have been encountered that we are going to, as we start to operate, we are aware of that. So that becomes the last part of our question in terms of this video. Let's stay tuned for more videos to come. Let's subscribe and share. Let's share the link to our colleagues who are doing grade 11 business studies. More typical examination questions are going to be uploaded. As for this video, I'm signing out. Let's meet again in the next video.